Good evening, everyone. Welcome to another FSMOne Education webinar series where we help investors to invest globally and profitably. First of all, thank you so much for taking the time and attending the webinar tonight. My name is Yvonne Tan from Client Investment Specialist team. Together with me is my colleague, Mr. Sean Lian. He is our Client Investment Manager and he will together be with us on the question and answer session towards the end. Our topic today is Unit Trust 101 from beginner to pro. So before we proceed, we take a look at the disclaimer. To summarize this slide, this webinar is designed for new and existing investors who are looking to understand and invest in unit trust. So the content of this webinar aims to provide an overall view of unit trust, and it does not contain any advice or information on the subject matter. So the example provided in this guide are meant for illustrative purpose only. So before you make any investment decision, please seek a professional advice from our client investment specialist team. So moving on, the agenda of today is an introduction of the unit trust investment. We will covering all you need to know when investing in unit trust, such as the fees associated and the types of the fund. Furthermore, we will also share how to choose and invest the suitable unit trust based on your risk profile. So, what are unit trusts? A unit trust is also known as a collective investment scheme or mutual fund. So, unit trusts are broadly popular and accessible to investors ranging from beginner to professional. So, in a unit trust, multiple investors will contribute their cash, and the combined fund are used to invest in a variety of assets by a professional fund manager according to the fund objectives and also the investment strategy. So the portfolio will comprise a variety of financial assets such as the money market, bonds, equity, and alternative investment. So generally, a unit trust is actively managed by the fund manager and aim to outperform the indices or the benchmark. So on FSMOne platform, we offer funds that invest in the local market, foreign country, and a combination of both for investors to explore and consider. Next, this diagram is displaying the structure of the unit trust fund, whereby the three main things to focus here is the unit holder, which is in orange circle, and also the fund manager, which is on right-hand side, green circle, and the trustee, which is on left-hand side, green circle. So before we go into deeper of each of the role of unit holder, fund manager, and trustee, let us walk through with you the structure of the unit trust at here. So the unit holder, they will invest by buying the units in the fund into the unit trust fund. And then the fund is invested into the authorized investment as specified in the deed, which is the bonds, the stocks, and also the derivative, money markets, and also cash. So the unit trust, if let's say that generates any return in terms of the capital gain or income distribution, it will go back into the unit holder. As for the fund manager, they are the one who manage the operation of the unit trust. And as for the trustee, they are the independent from the fund manager, and they are the one who will safeguard the asset of the unit trust. So let us focus more on what is the role of unit holder first. So a unit holder, they will invest by buying the units in the unit trust fund. So unit holder, they are the investor. They are also the beneficial owner of the unit trust. So unit holder will hold the rights to the trust asset, and whenever there is a capital gain earning, so there is a return from the unit trust. So they are the one who decide to invest or stop investing in the unit trust. And whereas if let's say for the fund manager, which is in the green circle on our right hand side, so they are the one who actually manage the operation of the unit trust. So fund manager will invest the pool of the fund collected from the unit holder into the authorized investment as specified inside the deed. So a fund manager actually, they will calculate the net asset value of the unit trust and the amount of the distribution at the end of the trading day. So for your information, fund manager in Malaysia, must be licensed by the Security Commission Malaysia. And thirdly is the trustee, which is on left-hand side green circle. A trustee will safeguard the asset of the unit trust and ensure that the fund is invested in follow with the trustee. So trustees are actually independent from the fund manager and the fund management company. So their role is to maintain custody or they safeguard the unit trust asset. So trustee will actually ensure that the fund manager or the unit trust management company follow the objective and the interests of the unit holder are protected. So trustee will remove whoever fails to follow accordance with the deed. So in general, investors who are 18-year-old and above are eligible to invest in unit trust. A unit trust is suitable for investors who are just starting out on their investment journey or they are unsure of how to select a individual securities. So it is also suitable for those investors who do not have the time to study each financial securities. Besides that, unit trust is also suitable for professional investors who have extensive experience in the financial market. So for those investors also having a longer investment horizon and having a purpose of investing for their retirement, education, or even buying a home or growing their capital are also recommended to invest into unit trust. So what you need to know is as a unit trust holder, you do not own the asset purchased by the fund directly. However, you do hold the direct ownership of the fund. So meaning to say that if let's say you are a unit holder, you do not own the asset from the fund, but you hold ownership of the fund. So the return of the investment in unit trust fund is usually in the form of capital appreciation. So generally, unit trusts are not suitable for short-term investors or speculators who are looking to cash out within a year time, as the gain made from investing in the unit trust may take some time to be realized, especially when market sentiment turn negative in equity market. And unit trust investment are best suited for investors who are looking to invest over the medium to long term. So for example, like 3 to 5 years and above. So as it generally will provide a better return at a level of risk acceptable to most investors. So when it comes to investing, normally new investor will face the following concern, such as low capital in hand. For actually there is too many options in the market and there is too little cash in hand to buy in each preferred stocks or bonds. And also investor will find it difficult to diversify their portfolio with the several stocks or bonds. So for example, the minimum subscription for a certain retail bond is 250,000 ringgit. So as an investor, this means that you need a very, very serious fund to diversify your investment. And thirdly, a new investor will find that they will need more time to understand the financial term or jargon in the market and the market outlook in the investing world. So it will be actually a lot of monitoring and also research working needed when they first kickstart their investment journey. So when investing in unit trust, there is actually a few benefits that investor will have advantage. And the first advantage is affordable. Anyone actually can have a unit trust fund due to its low capital investment. So it will require only a minimal investment amount, for example, 100 ringgit or 1,000 ringgit, and investor can use a small sum to buy into a well-diversified portfolio. So fund manager can trade in the investment product that are normally inaccessible to the individual investor, such as the government bond or the corporate bond or stocks that cost much more for just one lot. So with unit trust fund, an individual investor can enjoy the benefit of this investment product with a small capital outlay. Moving on, the second advantage is asset liquidity. So investing in unit trust will allow you to withdraw your investment at any time depending on the current price. So there is actually an ease in selling and buying the units as compared with investing directly in the shares of companies. As the fund manager, they are obligated to buy back the unit if, let's say, the investor perform a redemption of their unit trust. And the third advantage actually is diversification. You know the saying that goes, don't put all your eggs into one basket. So a diversification will actually provide investor to invest in a wider range of securities compared to when investors are investing on their own. So it is a more achievable goal, forming a well-diversified portfolio by investing into unit trust. So given that how time-consuming it may be, if an investor decides to create a diversified portfolio out of solely individual securities, so with a effective diversification are able to minimize the exposure to any one type of risk and optimize the return. So generally, if a loss is suffered by some investment asset, the impact of those losses will be offset by the gain enjoyed by other investment assets in the portfolio. And then the fourth point is unit trust is actually professionally managed and regulated by the Security Commission Malaysia. So there is a professional fund manager, which they are also a full-time, who have the necessary skill, relevant experience, and also there is a dedicated resources to maximize their investment. So a fund manager, they actually will simplify the investing for investors who are unsure how to select an individual securities or they do not have the time to do so. So investor may worry less as the fund manager will does it all for you. And next, another benefit is power of compounding. There is the benefit of starting early. As the earlier you start investing, the greater the opportunity to generate and accumulate a higher return on your original investment. So this is due to the effect of compounding. And last but not least is the tax benefit. Investor will actually enjoy a tax benefit as the interest income and also the capital gain from unit trust are tax exempted. So how is actually a unit trust price? In general, investor cannot determine the unit trust price to buy or to sell because unit trust only have one price per day, which is the market closing price. We call it as the net asset value. So net asset value is the total value of the fund. It is generally calculated daily and it will reflect it in the per unit price of the fund. So in general, actually there is two types of pricing for unit trust. The first one is the forward pricing and the second one is historical pricing. So what is forward pricing? Forward pricing, most of the unit trust scheme, actually they will calculate their unit trust price using this method. The investor will not able to know their actual transaction amount on the day they place the transaction. So let's say an investor, they place a buy order and make a payment in FSMOne before the cutoff time. Then he will be buying the units of the unit trust based on its closing price for that particular day. So once the market closed at the end of that particular business day, the fund manager company will require some time to consolidate, calculate and verify the unit price with an independent trustee, and thus investor will only know the exact unit price 1 to 2 working days later. So such pricing system is known as the forward pricing system. And next is the historical pricing. So historical pricing meaning to say that whenever they buy or they sell, there will be no lag time when they place the unit order. So this essentially means that investor buy order will be transacted on the same day if the buy or the switch order is placed before the cutoff time. Meaning to say that the difference is for historical pricing, investor whenever they buy in for that certain unit trust, they will know what is the price they are buying or they are selling. But if let's say for a forward pricing, the investor will not know what is the price they are buying or selling. They will only know after 1 or 2 working days later. So in terms of the unit trust price, actually we will recommend the difference of the unit trust price in the short term. It does not really matter because generally unit trusts are meant to help for a long time horizon of at least 2 to 3 years and above. So as long as the fundamental of your investment justify a higher valuation in the long term, then you need not to worry too much about the price difference and the short-term price fluctuation, especially if these fluctuations are caused by the weak market sentiment. So investors should focus on buying unit trusts that invest in the undervalued equity market and avoid those unit trusts that invest in the overvalued equity market. So how to identify the unit trust pricing method? So we may refer to the example here extracted from FSMOne website. This is the fund fact sheet of Principal Greater China Equity MYR Class Fund. So for this unit trust, you can look at the pricing basis here is forward pricing, meaning to say that whenever investor buy into this unit trust or the similar unit trust that having a pricing basis of forward pricing, then they will not know the exact pricings of that particular day. They will only know it one or two business day later. And as for on our right hand side is RHB Cash Management Fund 2, whereby the pricing basis is at historic pricing. So whenever investor buy into RHB Cash Management Fund 2, investor will know what is the price they are buying or they are selling. So next is the fee associated with the fund investment. So it also means the cost of investment. So when investing in unit trust, the fee associated is payable to two parties, which is the first one is borne by the investor, whereby the fee payable is to the distributor. So in this case, is payable to FSMOne Malaysia. And another type of fee is borne by the fund, whereby the fee payable is to the fund manager. So we will focus on the fee payable to the distributor first. So the first one is sales charge. So sales charge is actually a one-off fee that is charged for purchasing into the selected fund. So it is more widely known as the commission or servicing fee that agent or unit trust distributor charge for distributing the investment product. So general at FSMOne, our investor will pay maximum up to 1.5% sales charge on the equity fund, balance fund, alternative investment, and mixed asset, whereas the bond funds and money market fund are 0% sales charge. Moving on is the platform fee. So platform fee is only applicable to the units of bond fund purchased using cash. So this does not apply to the bond fund that purchased using the EPF money and the PRS fund. And the platform fee is accrued a daily basis and is deducted on a quarterly basis. So at FSMOne, our investor will pay 0.05% platform fee per quarter. And moving on, we will look at the fee payable to the fund manager. There are 5 types, which is the annual management fee, trustee fee, annual expense ratio, switching fee, and also redemption fee. So we first focus on the annual management fee first. So annual management fee is an annual fee charged by the fund manager for managing the fund. It will cover the management expenses incurred by the manager, such as the operating costs, audit and administrative charges, which include the brokerage fee, distribution fee, rental, or even staff salary. Whereas the next is the trustee fee. So trustee fee is payable to the trustee for acting as a custodian of the fund asset by supervise and safeguarding the unit holder interest to ensure that the unit holder is protected and to ensure that the assets held in a fund are managed appropriately. And moving on is the annual expense ratio. So annual expense ratio, normally we will receive a lot of inquiries from our investor that they are confused between the annual expense ratio with the annual management fee. So annual management fee, they actually does not include the trustee fee or auditor fee or even the tax agent fee. However, the annual expense ratio are the combination of the annual management fee and trustee fee and other operating expenses of the investment. So it is deduct from the unit trust fund annually. So the net asset value of the unit trust published daily would have already taken into account the prorated annual expense ratio. So the purpose of this annual expense ratio is to let investor to know how much is the expense incurred in operating a fund. So the higher the annual expense ratio, the greater the expenses it is. And next is the switching fee. So switching fee, it is the amount investor might have to pay when investors switch their investment directly from one unit trust to another unit trust provided by the same or different asset management company. So switching fee may differ from one asset management company to another. So typically a switch from an equity fund to a fixed income fund, they are free. But if let's say from a fixed income fund to a equity, then there is a switching fee. And last but not least is the redemption fee. Redemption fee is also known as the withdrawal fee. So a redemption fee is the amount investor might have to pay when investors sold or withdraw their investment from a unit trust. So most of the fund in FSMOne Malaysia platform, they do not have the redemption fee. And please do take note that there may be other direct and indirect fee involved. So make sure that you read and understand the prospectus of the unit trust before you take any action in investing. So you can see from the arrow in red color here, which is pointing to sales charge, switching fee, and also redemption fee. Actually, it is incurred as per transaction basis, meaning to say that every time you do a new purchase of the unit trust or you do a top up, then it is incurred per transaction basis only. Whereas the green color arrow is pointing towards the platform fee. So it is only applicable for the bond fund investor only. And next is the blue color arrow, where pointing to annual expense ratio. And this one will be accrued on a daily basis and reflected on the net asset value of the fund. So investor actually do not have to make separate payment for the fees for annual expense ratio. So basically, this is the few charges that is payable to distributor, which is the sales charge and also platform fee, whereby you borne by the investor. And this is the fees that will be borne by the fund, which is payable to the fund manager. And moving on is the cooling off right. So this slide is actually would like to let new investor to know that whoever that invest for the first time, they actually entitled a cooling off right if let's say they change their mind about a certain investment. So the new investor can make a full refund within the 6 business days when they first make the investment. However, there is a following person or institution that are not entitled to exercise the cooling off right, which are the corporation or institution, or they are the staff who employed by the fund management company, or they are a person who registered with a body approved by the Securities Commission to deal in the unit trust. So given that there are many types of fund available on FSMOne Malaysia platform, so investor may enjoy the flexibility of utilizing different combination of asset classes to achieve their investment goals. So some may choose to invest in a broad-based manner, and others may prefer investing in a particular sector or country. So unit trust funds are mainly categorized based on 3 main aspects. And first one is asset classes, and then second is sector, and the third one is geographical allocation. So we will focus on the asset classes first. So within the asset classes, there are actually money market, fixed income, balance fund, alternative investment, and also equity. So each of these classes, they actually have a variable risk level and rewards. So so each of them, as you can see, for money market, it actually is a fund that invests in an institutional deposit. And the fund in this category are often viewed as a cash equivalent placement and could serve as a parking facility for investor. So normally the objective for people to invest into money market is to provide a preservation of the capital. And as you can see that among all the asset classes, money market will have a lower risk rating. And of course, the return will be definitely lower. And the next one is the fixed income. So fixed income fund is a fund that invests into the bond market, such as the Malaysian government securities, corporate bond, and also it aims to provide a regular income with less emphasis on capital growth. And next is the balance fund. So a balance fund is a fixed income fund which invests into the both the bond market and also the stocks. So it will have both exposure in both type, and generally the investor will looking towards for a growth and also income in between. And next is the alternative investment. So alternative investment is an invest into those non-traditional asset classes such as the derivative, real estate, commodity future, hedge fund, and the private equities. So alternative investment strategies are typically active and return-seeking strategies that also often have the risk characteristic different from those traditional investment. And last but not least is the equity. Equity is a fund that invests in the stock market, whereby the company is listed in the public stock exchange such as the KLSE, Hong Kong Exchange or US Exchange, and etc. So the objective is to provide a reasonable rate of return on the income and to realize the capital growth. So among all the asset classes, equity fund will have a higher risk rating, and also they will provide a potential higher return. So aside from asset classes, a fund is also distinguished by the sector it invests in, and normally unit trust will invest into one particular sector, and it can be globally or sector specific within a country. So the types of the sector can be general, can be consumer discretionary, financial, golds and minerals, and etc. So if let's say those funds that do not have a specific preference on sector allocation, then they are categorized under general category in FSMOne platform. And there are also various type of sector available on the platform, such as consumer discretionary, which invests into those non-essential goods and services. And there is also the sector-specific fund, such as the technology, healthcare, or commodities that are mostly narrowly focused fund, which experience a greater volatility, but they can deliver a higher potential return. So unit trust fund is also differentiated by the geographical region it invests in, and they are primarily the global fund, the regional fund, and also single country fund. So for a global fund, it will invest into all over the world. As for the regional fund, it will invest into those major economic regions such as Asia, Japan, US, and Europe. And whereas the single country fund, they will invest into one country only, which is like Singapore, China, and India. So each market actually there has their unique economic characteristic, and they will poses a different level of risk and performance. So the variety of fund that FSMOne offer will enable investor to tap into exciting investment opportunities. For example, in the global tech space, and then the investor can also ride on the demographic trend in the emerging market, and at the same time, investor can also reap the benefit of the fast-paced growth in Asia at the same time. So as FSMOne offers a broad selection of unit trust fund from multiple asset management company, which means that investor will not be limited in terms of choice, whether you are an investor looking to make a safe and stable investment, or you are an aggressive investor who are willing to take risk for a higher return. So you can find unit trust fund for every risk appetite and investment goal in FSMOne Malaysia. So investor actually can utilize the fund selector in FSMOne in order to filter out the funds to a manageable shortlist according to the specific requirement and preference based on three main aspects, which is the asset class, the geographical, and also the sector. So this will actually help an easier comparison and filter the fund with their peers accordingly. For example, like a risk rating or EP, whether it is a EPF approved fund or not, or whether it is a Sharia compliant fund or not. So this is an example of fund fact sheet extracted from our website. So from here, you can see Principal Greater China Equity MYR class is an example of we extract from the FSMOne website. And this fund actually the risk rating is quite high, which is at 8. So why is the risk rating is at 8? It's slightly higher. It's because it invests into the equity. So the sector that they are investing is in general, and the geographical allocation is investing into Greater China, meaning to say that this fund, actually they are investing into China, Hong Kong, and also Taiwan. And this fund is actually approved by EPF. So what does this mean? Actually, this means that an investor, not only they can use their cash investment to buy into this fund, but they can also use their EPF investment to buy into this Principal Greater China Equity Fund. So from on the right hand side top of here, you can see the latest net asset value at here. So this will serve an investor as the indicative price whenever they would like to buy or to sell the fund. So why it is stating as an indicative is because this price, whatever price that you are buying, it will only reflect 1 to 2 working days later. You will only know the exact price that you are buying, because this is the pricing basis is actually in forward pricing. And next is the you can look at each of the documents disclosure by this fund, whereby you can know the prospectus, the annual report, the product highlight sheet, and also the fund fact sheet of this fund. So you can read more information about this fund by reading this document, because the fund fact sheet will be updated periodically. And also investor can know more information about the investment objective. So from here we can know that okay, this fund is actually investing into a target fund, and this they can also read on their fund objectives from here. So next, so before you buy a unit trust or fund, you will be notified with the documents such as the prospectus, the product highlight sheet, and the annual report. So earlier we talked about we can always refer to look more information from the document. So what is each of these about? Actually, a prospectus is a document that will provide a detail on a unit trust. So it will let investor to know the investment objective, their strategy, what is the risk exposed, and also the fee and charges and other material information. So it is essential for investor to read the prospectus before investing into a unit trust. So for your information, all unit trust management company are legally required to issue a prospectus, and investors are advised to read the prospectus to identify the type of the fund that best suit your investment goal, as the prospectus will contain the information that underpin the fund overall performance. So take some time to read and find out about if a particular unit trust fund match your own risk appetite and your investment profile. And next is the semi-annual report or annual report. So a management company must prepare an annual report and a semi-annual report of the fund to provide all the necessary information to enable the unit holder or to enable the investor to evaluate the performance of the fund. And third is the product highlight sheet. So product highlight sheet is a summary of the information of the fund. So it will highlight the key feature and the risk of the fund. And last but not least is the fund fact sheet. So fund fact sheet is manager will publish monthly or quarterly the updates on their funds. So investors are encouraged to read this material to monitor how your fund is performing. So normally inside the fund fact sheet, the fund manager will inform the investor that what had happened through all this month or what had happened through all this quarter. So they will let investor know whether there is any rebalancing in the whole total portfolio of the unit trust, and then what is the current market outlook. This is the information that will listed in the fund fact sheet. So how do investors will invest in a unit trust? First, they may speak to an authorized unit trust consultant, because all investment they have a risk. So give it some thought before you start your investing, and you may ask what is the risk appetite, and do you actually understand the charges and the potential risk of investing in the fund, and what are your goals and your timeline in undertaking this investment. So by knowing the risk of your investment, investor can then only decide whether or not to accept the risk and how to manage the risk to make your investment safe. So investor may read more information on a fund risk which is readily available in the prospectus. So as riskier investment will tend to offer a higher return, so but with the possibility that they may fail and not provide any return at all. So whereas less risky investment are more dependable and predictable, but generally will offer a lower return. But because they are risks, it does not mean that the investment is not safe, because a good investment with a strong fundamental value will provide a decent return. So the example of risk of investment will depend on various factors, which including the market condition, the economic condition, the effectiveness of the company's management, and also the government regulation. So it is always good to identify your risk appetite before starting an investment. You should never invest more than you can afford to lose. So the amount of risk that you are willing to take is called your risk profile. So you may ask yourself, how much risk are you willing to take as an investor? Whether you have 100 ringgit or 1,000 ringgit extra per month to invest with after excluded your monthly fixed expenses. And then what is your expectation to the risk and reward on your investment, regardless of the size. So by doing a risk profiling, you may determine your own risk appetite and be able to tolerate the fluctuations in the return of your unit trust fund. So hence, we strongly suggest clients to invest within their risk tolerance level, so that they wouldn't make a wrong decision during the market uptrend or the market downturn. So be aware of your risk tolerance level and ensure that your investments are evenly distributed across the various types of investment asset. So therefore, investor may log into FSMOne Malaysia website and proceed to check your risk profile by simply answering a few questions. So you may log in and then click account update and then click my risk profile and then just answer a few questions and you will know your own risk appetite. So from here, investor may understand more about your own risk, your own investment horizon, your risk appetite, and your investment goal. Furthermore, after investor has done a risk profiling, you may seek our client investment specialist to recommend the portfolio that suits your risk appetite. The client investment specialist will provide a suggestion and construct a well-diversified portfolio with the fund recommendation. So when you do your risk profile, you will know that what type of risk profile you are in. So in FSMOne Malaysia, generally there is a 5 type of risk profile, from conservative until the aggressive. So there is a certain key traits for different risk profile, and then we will recommend a default allocation in order for you to invest. So if let's say an investor, he is a conservative type of person. So meaning to say that this investor is a risk averse and seeking for a capital preservation. So they may desire lower risk investment and they are actually okay with a lower return. So we will recommend the default allocation to invest in 90% into the fixed income and 10% into the equity. As for the balanced risk profile investor, they were looking to balancing the market risk and also return, because they prefer to have a stable income to overcome the inflation. So they are actually okay with small losses. So the default allocation would be to put into 50% into the fixed income and 50% into the equity. And then for aggressive type of risk profile, this type of investor, they are trying to maximum the return in a short and medium term. So they are actually those investors who are able to withstand the market volatility and they can accept certain of capital losses. So this type of investor, they can put in 10% into the fixed income and then another 90% they may invest into equity. So investor may ask how to choose the suitable unit trust. So this is very much depending on your current stage of life, whether you are a single person or you are married, whether you are a fresh graduate or you already are a working adult or you are someone who already start to retire. And also it will depending on the level of the saving and income after deduct your monthly fixed expenses. It is also have to investor have to look into their risk tolerance on how much risk they are able to tolerate and what is their investment goal. They are investing for their retirement or they are actually investing for their education or for their children or they are investing for buying a new home. And how long will this investment timeline will be? Is it 1 to 2 years or is it 3 to 5 years or above? So investors should focus on the investment style of the asset management team, whether the investment strategies have paid off in the long run. They can look at the historical return. And an asset management team with the quality one are those who are able to deliver a strong and resilient return to investor over the long term. So investor can read more information of the fund and about their investment objective, whether it is in line with your own investment objective as well. And then investor can also look at the fund performance and also the volatility of the fund. So while a fund past performance is not an indicative of its future performance, it is still useful for you to compare the fund performance to its benchmark and other fund with a similar investment objective. So investor can look at the fund performance in the fund fact sheet. There is generally 3 types of fund performance, which is the annualized return, the cumulative performance, and also the calendar year return. So more importantly, don't just look at how the fund performed in the last year or 2 years ago, because this might be influenced by the cyclical event. So a better way to do this is by looking at the performance of the fund over a longer period, preferably over the past 3 to 10 years and above. So it is a sign of a long-term stability and a potentially a good management on the parts of the fund manager, where we should bode well for investors who are looking for a long-term return. So this is a sample of the fund performance displayed in FSMOne Malaysia. So we extract the example of Principal Greater China Equity Fund MYR class. So from here you can see there is annualized return, cumulative performance, and the calendar year return. So this is actually extracted on 25th of July, year 2022. So let us focus on the annualized return first. So the annualized return is the average return of the fund based on the latest net asset value. So the latest net asset value is based on the 21st of July 2022. So for example, the table is showing a 3-year yielding at 8.55% as of 21st of July 2022. So it is actually meaning to say that this is the average return over the 3 years based on the latest net asset value up to this particular date. Okay. And then the next is cumulative performance. So cumulative performance is the total accumulated return backdated to the respective period. So for example, we take a look at the 1-year performance. So 1 year, it is at a negative 22.05% as of 21st of July, year 2022. So it means that the cumulative performance period is taken into calculation from 21st of July, year 2021 until 21st of July, year 2022. So if it is a 3-year cumulative performance, so it will backdated 3 years until the latest net asset value. So the percentage of the return will change simultaneously according to the latest net asset value. So the value that you are seeing today for the 1 year here, 1 year or 3 year today, you might see it differently tomorrow because it will reflected based on the latest net asset value. If let's say there is a change in the net asset value. And next is the calendar year return. The calendar year return will show the respective year return of the fund. So as you can see that the year 2019 and year 2020 are performing at 22.62% and 36.08%, whereas year 2021 are having a negative 3.65%. So as you can see, we always said earlier our slide, we did mention that we should not focus on the unit trust in 1 or 2 years return only because it might be due to the cyclical event. So investors are encouraged to look at the unit trust at the longer term, for example, 3 years and 5 years to get to know more about the fund performance. So this is how we may understand and analyze the unit trust based on their respective fund performance. So next is volatility. So when it comes to selecting a fund, investor should look at both the risk and the return. Return is easily shown in the fund historical performance, but risk is harder to ascertain because it is, however, very important and it is possible to lose all your money in a risky fund, especially when markets are uncertain and also volatile. So investor may look at the risk metric, which is shown in the fund fact sheet as well. So may focus on the 3-year annualized volatility stated as here. So the volatility metric is actually will show let investor to know how volatile is the price fluctuation of the fund. So if the volatility is very high, it means that the fund price fluctuate more widely. It gives a measure of how much the fund price has fluctuated over the period. So a higher figure will indicate a greater volatility. And next is the Sharpe ratio. Sharpe ratio is a method that can be used to calculate the risk and the return of the investment. So investor can look at the 3-year Sharpe ratio at here to compare with its peer. So a Sharpe ratio can be used to compare the performance of a portfolio or the fund manager among their peer. So it will help investor to understand and measure the return of an investment compared to its risk. So generally, the greater the value of the Sharpe ratio, the more attractive the risk-adjusted return, and of course, the fund performance will be relatively better. And if let's say you see there is a negative Sharpe ratio, then so this means that the portfolio has underperformed its benchmark. So investor should compare the Sharpe ratio of the unit trust with a similar investment objective with a similar geographical market and the sector to identify which fund will provide a better risk-adjusted return. So in summary, investors should focus on a higher Sharpe ratio and a lower volatility. And earlier we talked about Sharpe ratio, the benefit of it. There is also limitation of the Sharpe ratio because Sharpe ratio is not so useful towards the short-term trader since it is designed to analyze only the long-term investment. So Sharpe ratio is suitable for investors who plan to trade the investment more than a year. If you only end up holding your investment for less than a year, then this ratio wouldn't really apply to your investment anymore. So the key takeaway at here is the Sharpe ratio is an important tool to understanding your investment. It will take into account your return and your risk, and it will show you whether your return are worth the level of the risk you are taking on. So we believe that while a good fund manager should deliver a good return, he must also manage the volatility of the fund effectively. So in other words, a good fund must have a better than average Sharpe ratio. So next, this slide is about income distribution is not equal to the return of the unit trust fund. So generally in FSMOne, if there is any income distribution in the unit trust, it will be reinvested in the units of the relevant fund. So why in this slide I mentioned that income distribution is not equal to the return of the unit trust fund. Let me share with you further the mechanism of the income distribution for unit trust first before we dive into that deeper. So in unit trust, upon there is a declaration of an income distribution, any interest income and realized capital profit are paid to the unit holder. So consequently, you will see there is a drop in the fund net asset value, and the fund net asset value will tend to fall by approximately the same amount as the income distribution. So before the unit are reinvested for you, you will see a temporary decrease in your profit percentage in your holding. So when the income distribution process is complete, you will see an additional unit in your fund holding, and the temporary decrease in your profit will be normalized. So the income distribution, actually, it does not really generate extra earning to your current holding. So this is why income distribution for a unit trust is merely returning the investor money back to them. So as a dividend payout in the unit trust investment is not the same as the stock investment, whereby the unit trust will distribute the income to its investor in line with its declared distribution policy and not directly measured by the dividend yield. So the income distribution is fully based on the fund manager's discretion. So the fund manager, they have the right whether or not to declare the income distribution to the investor or not for that particular period. So if let's say the fund manager does not declare any distribution, they might reinvest the dividend payout from the underlying asset if they find any new opportunity in the market. So hence the capital will continue to grow. And in fact, it is mechanical possible for unit trust to declare income distribution even if it doesn't deliver any return over the particular period. So therefore, an investor should focus on the fund performance instead and not the frequency of the income distribution. So for example, investor may focus on the unit trust that invest into those high dividend yielding stocks, which also known as income focused fund. And next, this slide we will talk about the non-hedged versus hedged fund. So you can see there is an example showing here the Principal Greater China Equity Fund. There is a MYR class and also the MYRH class. So what is actually the difference between these two funds is actually the currency risk. So for a class MYR, meaning to say it's a non-hedged fund, this class, the class of the unit is actually issued by the fund are denominated in Malaysia ringgit. So investor will get a market return plus the foreign exchange gain or losses. Whereas if let's say for the class MYRH, which is the hedge fund, the class of this unit issued by the fund are denominated in Malaysia ringgit that aims to minimize the effect of the exchange rate fluctuation between the base currency of the fund and MYR. So for the Principal Greater China Equity Fund, their base currency is US dollar. So in this case, the MYRH class, they are putting the hedging strategy between the base currency of US dollar and the share currency MYR. So for the hedge class, investor will get a pure market return as they do not need to take the currency risk as the fund manager will apply a hedging strategy to hedge against the currency risk. So the volatility in the hedge fund is relatively lower compared to the non-hedge fund as our local currency in the MIR class is hedge against the base currency of the fund, which is in US dollar, to lower down the exchange rate risk exposure. So investor will be questioning which one should I choose, the MIR class or the MIRH class. So if you are willing to take more risk and foresee that our Malaysia ringgit to depreciate further in the near term while investing into this fund, then you may choose a non-hedged class, which is the class MIR, to enjoy the difference in the exchange rate. However, if you prefer a lower risk or foresee that Malaysia ringgit to strengthen further, then you may choose a hedge class, which is the class MIR, to lower down the exposure on the exchange rate fluctuation. So by understanding the classes of the non-hedge and also the hedge fund, investor may make decision by considering whether to have an exposure to the currency risk or not. Moving on, this slide is about the currency share class. So earlier we talked about principal Greater China Equity Fund. The base currency is in US dollar. So what is base currency? Base currency is actually means the reporting currency. So it means that the financial report they are prepared using the currency of US dollar, which is the base currency. And if let's say for the currency share class, it means that this is the dealing currency. So the dealing currency is the currency in which the fund are passed on to the fund manager or the investor during the subscription or redemption of the unit trust. So a fund can have more than one currency share class, for example, in Sing dollar, in renminbi or Australian dollar. So an investor may invest in the unit trust through the various share classes offered by them. So for instance, the different share class of an equity fund may look something like this. So you will notice that the main difference between the various share class of the same fund are typically their currency denomination or the dealing currency. So some of them are denominated in Malaysia ringgit, for example, and then whilst others are denominated in US dollar, renminbi, or Sing dollar. So don't be confused because there is not much difference in terms of the performance of the different currency classes over a period in Malaysia ringgit term. And it is pointless for investor to convert their ringgit to invest into the unit US dollar class and to convert back the ringgit after taking profit. Because in this case, you may suffer losses on the foreign exchange conversion rate. So the purpose for the multi-currency setup is for the convenience of the investor who has a foreign currency in hand so that they can invest using the foreign currency in hand without convert into Malaysia ringgit for the investment. So we will suggest an investor to invest the currency on hand that they have and do not purposely convert and invest in a different currency class because you will suffer losses on the foreign exchange rate. And since actually we are investing in equity fund and not the foreign exchange, so we should focus on the potential return of the fund performance instead of the currency gain or currency losses. So next, this slide, we will talk about the relationship of the target fund and the feeder fund. So what is target fund and what is a feeder fund? A feeder fund is a unit trust fund that invests into the target fund. And what is the difference between a feeder fund with a regular unit trust fund? Whereby a feeder fund, they will invest into a target fund, such as the collective investment scheme. While a regular unit trust scheme, they will invest directly in the investment securities, such as the stocks and the bonds. So why in the unit trust market, there is this assistance of the feeder fund structure into the target fund? There is a few reasons. And the first one is the fund houses are required to obtain the fund management license and comply with the regulation in Malaysia for them to distribute the unit trust fund in Malaysia. So that is the reason why foreign fund houses, they cannot simply establish a fund in Malaysia and distribute it here. And then the second reason is as it is nearly impossible for our local fund house in Malaysia to physically locate their fund manager in different countries or regions such as US, Europe, or China for the fund management purpose in the long term. So therefore, you will notice that most of the feeder fund are foreign fund which local fund manager has difficulties reaching out to the daily operation of the fund management. So we will receive also inquiries from the investor if there is an existence of the feeder fund structure. So will there be a double charging for investors who are invest into the feeder fund structure? So please be rest assured because the local fund manager actually is prohibited to double charging the investor on the feeder fund structure. So generally, the fund management fee of the feeder fund are higher. And so, for example, if let's say the feeder fund is charging at a 1.8% management fee and 1.5% will go to the target fee, then the 0.3% will go to the local fund manager. And next, this is an example of a target fund. So we're also using the same example, which is the Principal Greater China Equity Fund. This fund is a feeder fund fit into the target fund of Schroeder ISF International Selection Fund Greater China. So the performance of the feeder fund would to a great extent linked to the price movement of the target fund, which in turn is reliant on the performance of the underlying investment that it is invested in. So the feeder fund performance is dependent on the target fund manager expertise in managing the fund. So this means that if the target fund performs well, then the feeder fund may reflect the similar performance. And likewise, if the performance of the target fund falls, then the value of the feeder fund investment will also be affected. So next, we will talk about the retail fund versus the wholesale fund. So what is the difference between the retail fund and also the wholesale fund is retail fund will cater for the ordinary individual investor and it will generally involve a lower minimum investment amount. So the retail fund, they have a disclosure requirement and a regulation tend to be a lot of higher for the retail products with the intention to provide investor with a greater level of consumer protection. So you can see that retail fund, they are normally those evergreen and medium to long-term investment. Next is about the wholesale fund. A wholesale fund will cater to those sophisticated investors, such as those high net worth individual and corporate investor who involve a higher minimum investment amount. So this type of wholesale fund, they can access a wider and more complex range of investment product, which may have an enhanced risk profile and require a more complex investment strategy to meet their needs. So investors actually they are required to fulfill and to declare as a sophisticated investor in order to invest into the wholesale fund. So a sophisticated investor is those investors who have a high net worth and extensive experience in the financial market. So this is an example of the retail fund. For Principal Greater China Equity Fund, you will see that the wholesale fund is no, meaning to say this type of fund is a retail fund. Whereas on the right-hand side is the Hong Kong Tech Index Fund. This type of fund is stated as a wholesale fund is yes, meaning to say that if let's say investors are interested to invest into the wholesale fund, whenever they click into the wholesale fund, such as the Hong Kong Tech Index Fund, a pop-up declaration will pop up when the investor click into the fund on our FSMOne website. And these terms stated on the website are for investors to read, acknowledge, and also accept before they proceed to invest. So earlier we talked about the investing into unit trust. We must speak to an authorized unit trust consultant, and the distributor and the consultant of the unit trust scheme will be able to guide and help investor to choose the unit trust that is more suitable to your needs and your investment goal. So investor have to make sure and be careful that the distributor or the consultant that you are dealing with is authorized by the Federation of Investment Managers of Malaysia, FIMM. So always check if your distributor is registered or not by simply visit the FIMM website. There is a list of all the registered distributor, including us, FSMOne Malaysia. As for the consultant, you can visit is my consultant authorized page by scrolling down to FSMOne website, scroll to the most bottom and look for UTC/PRC online verification and search the consultant name or their FIMM number by keying in at here. And then if let's say their detail appear here and verified them, that means to say that this consultant is registered and authorized. And next is investing to make more money is the smart thing to do. But we also like to reiterate for new and also existing investor to be alert and be aware of scams and do your research and remain vigilant at all times and check if the investment is authorized by the Security Malaysia and whether the unit trust scheme opportunity or the consultant is authorized by the FIMM or not. So be aware of receiving those calls or dealing with those suspicious message such as SMS, Telegram or Facebook or even Instagram. So if let's say there is in doubt, do not make any cash transaction to any parties without making a phone call to our official hotline at 03-2149-0567. And our friendly customer service representative would assist to verify if it is legitimacy or not. So a consultant should not accept cash or cash deposit from investor into their personal bank account, whether it is a cash or online transfer or even check. So all investment payment should only made to our FSMOne official bank account, which is Standard Chartered Bank and Maybank, whereby the account name is iFAST Capital Sendirian Berhad Client Trust account. So if you are required to make a fund transfer into another account other than the mentioned bank account here, so it means that it is a higher chance that you are dealing with a scammer. So how to detect a scam and protect yourself against it? First, do not click on the links that look odd and fishy. Secondly, always cross-reference the phone number with the official website. And thirdly, be aware of the bank account details. So please make sure that you know the difference between an investment opportunity and a scam. We are actually striving to make our investment community a safer place to be in. So we hope that this piece of information could save investors from falling prey into any or another scam case. And next, we receive a lot of inquiries from investors whereby whether unit trust scheme is risk-free or not. And the answer is no. However, the risk is lower as compared with other investment instruments, as a unit trust scheme are based on diversification, and the risk is reduced through the purchase of a wide array of different assets. So although unit trusts make it easy to diversify your portfolio and balance out your risk, different funds will cater to different types of risk and reward appetites. So a high growth fund will carry a high risk. And it is important to remember that returns are not guaranteed. So even if a fund you choose is considered to be a low risk. And another frequently asked question from investor is, will I get my money back if the fund house winds up? So in the event a fund house ceases its operation, the investor need not to worry about their investment, and the asset of the unit trust are held separately on trust by the trustee for the benefit of the unit holder. So in earlier our webinar, we talked about the unit trust structure, whereby the role of the trustee is to safeguard the asset of the unit holder. So in the event of the fund manager goes into liquidation, a meeting will be called by either the manager or the trustee for the purpose of determining an appropriate course of action. So if, let's say, a resolution is passed at the meeting, the trustee will take the necessary step to wind up the fund, and the trustee then have to ensure that the proceeding have been distributed to the parties to the unit holder in the same proportion as their holding of the unit. So in summary, at FSMOne, we advocate unit trust investment, but we are also a strong proponent of investors education, as one of our primary responsibility is to ensure that investors know what they are investing in and are able to make a profitable investment decision in the long run. So all in all, prior entering into any investment, it is crucial for investors to understand the mechanism of the relevant investment vehicle, and always do your research and homework and understanding what you are buying into to have a good appreciation of the risk and also return involved before parting your hard-earned cash. So while a decent economic environment may have a buoyed investor sentiment and prompting investor to invest more or either to invest lesser to be in a defensive mode, however, we continue to advocate investor to invest via a portfolio approach and encouraging active management and practicing the portfolio diversification, because we believe that investor will be rewarded over the long term if discipline is put into handling their portfolio in a systematic way. So I hope the information will give you some idea on what are unit trusts and how to start your investment journey in the long term via our FSMOne Malaysia platform. So ladies and gentlemen, before we move on to the question and answer session, if you have any questions, feel free to type your question in the toolbox there, and we will answer your question as many as possible. And I'm pleased to invite Mr. Sean Lian, our Client Investment Specialist Manager. He will be with us through all this question and answer session.
Okay, thank you, Yvonne, for a very detailed and also comprehensive introduction of the unit trust product. So, okay, we have few questions over here. I will try to answer all one by one. Okay, the first question is, what is really specific risk for small cap fund? Okay, for small cap fund, basically, actually, the specific risk is actually they are very concentrated fund, because for some for small cap fund, right, actually the fund manager only allowed to invest into small and mid cap company. So because of this specific sector, so the fund manager, they are not able to invest into larger cap. So means the risk actually is more higher compared to other general funds. And then the second question is, based on the fund fact sheet for most small cap fund, they have unusual large portion of cash. Care to explain why? Okay, actually, the cash portion, the large cap portion in the particular small cap fund, actually is very depending on the fund manager discretion or their investment strategy. So I could not explain why. It could be based on fund manager view on the market. They prefer to keep more cash, and then so that they are able to deploy the cash when the company or when the equity fund go lower. So the third question is, do balance or a mixed asset funds suitable for long terms, or I better off invest in a PRS funds? Okay, I think it's very hard to answer this question, because we will need to know what is your risk appetite in order for me to answer, because a PRS fund, they will also have an aggressive fund or balanced fund or even a conservative fund. So it's very hard for us to compare whether the balanced fund or mixed asset fund, it will be outperform PRS fund in the longer terms. It will depend on your risk appetite and also what type of PRS fund that you mentioned. And then the question number 4, why most return from equity general, means the general equity funds, very low compared to small and mid cap funds? So they mostly invested in blue chip stock, well-known and established company, and the question marks. Okay, basically, when you're talking about the the investment classes or sectors for the unit trust fund, we do have these equity invested in general sectors. And also we do have this equity fund invested in specific sector, for example, small and mid-cap funds or even technology funds. So the difference within these two is the equity general fund, the fund manager is able to invest in various sectors. Means they can invest in banking, they are able to invest in all type of different sector that are provided in the particular exchange. But whereas for the fund manager, they have more specific investment strategy on like, for example, small cap funds. Actually, they only can invest based on the small cap indication or the small cap mandate that's stated in their prospectus. So means they are not able to move, or they are not able to switch to others sector easily when the economy on the particular, maybe for example, the economy cycle on the small cap fund actually turn back. So that's why the return and risk for the small cap or specific sector funds, it tend to be higher compared to the equity generalist funds. So I will go for the second question. Okay. Since ETF and FSMOne managed portfolio is having lower in management fee, so what's the main advantage investing in unit trust? So for investment in FSMOne managed portfolio, investment is diversified to equity, ETF, and unit trust, right? Okay, let me answer the second question first. So for FSMOne managed portfolio, the investment actually is only diversified among unit trust fund only. So the fund manager, the portfolio manager, currently the portfolio manager will help investor to create a diversified portfolio using unit trust fund as a tools only. So going forward, actually, we will add in, the portfolio manager will add in ETF as one of the tools, which it will be a mixed strategy with unit trust and ETF. But that one we will announce later on because we are still building for the system. And then for equity fund means the stock and ETF, for the stock market, for the individual stock, actually the portfolio manager do not handle for individual stock selection for now. So currently it's just unit trust fund. And then the first question would be since ETF and FSMOne managed portfolio having lowers in management fee, what is the main advantage investing in unit trust fund? Okay, the main advantage that investing in unit trust fund compared to ETF or managed portfolio is basically our platform, we do provide different investment tools for investor. So those investment tools that the participant mentioned here is ETF, managed portfolio, and unit trust. So it will vary depending on the individual investor, whether which are the fund or which are the product that they are more familiar and they are more comfortable to invest in. So each of the investment actually, each of the product actually, it will carry a different kind of risk as well. And then it will also carry, it will also need different kind of knowledge or different kind of understanding or professionalism to handle for that particular product. So it will depend on individual investor whether you are more comfortable investing in unit trust, ETF, or managed portfolio. Of course, for these three products, for those investor, new investor, or investor that they do not want to, they do not have any investment knowledge and they do not want to hands-on to manage their investment, actually they can go for managed portfolio. Because for managed portfolio, the portfolio manager will basically they will handle all the investment decision, they will handle all the investment performance rebalancing for you. So you basically it's a hand-off kind of investment if you compare to unit trust investment and also ETF investment. So, okay, I will move to third question. I think this question is multi-billions question. Is it a good time now to invest in unit trust? I think no one know, but what I can share with you is for now, basically most of the market actually is in quite attractive valuation because market has been going down quite a lot. But I could not tell you whether now is the bottom and it's a very, very best time for you to go in right now. But I could share with you that as long as you invest during market downturn, actually it will pay off when market rebound in future. So the best strategy is if you want to invest during this time, the best strategy will be you need to adopt a regular saving plan, means you need to invest regularly. You need to separate your investment, or you need to separate your money into few batches and invest into the market gradually. Okay, I think I have two questions on the PRS fund. So, okay, the question here is, what about for PRS fund, where one fund go into many other different unit trust fund? So are there any double charging here? So basically for PRS fund, same as what Yvonne explained on the feeder fund structure. So PRS fund basically is the feeder fund structure, or more on fund of fund. Means the unit trust fund manager, they do not pick the stock, the individual stock directly. So the PRS fund manager, they will pick the unit trust fund and invest using the PRS fund. So this kind of structure actually is fund on fund, and then is similar to feeder fund structure. Fund manager is not allowed to double charge investor because they will have a different kind, means they will have a separate calculation on the annual management fee. Means if all the funds, maybe for example, if the fund manager invests into 6 funds, so all the 6 funds, the annual management fee, it won't be double charged. Means it won't be add up together with the PRS fund. Means the PRS fund annual management fee or annual management fee, it will be covered for all the fund that unit trust fund that they invested in. It won't be double charged. So let me cancel off. Okay, I have another question here. Which is better, a foreign fund with base currency in USD, others, or in MYR? Okay, just now Yvonne also explained about the currency class. So it would depend on individual investor, whether do you have USD in hand, or do you hold maybe Australian dollar in hand, or are you holding the MYR in hand? So our advice is you just need to invest into a fund that carry the currency that you have in hand. If you have MOI in hand, then you just invest in MOI classes. Or if you have USD in your banks, then you can invest in the USD class if you do not want to convert your USD to other currency. So this is because basically the purpose of different currency is to facilitate for the convenience for those investors that have different foreign currency in hand, but they do not want to convert back to MYR. Okay, then we will go for the next question. Can investor predict price movement from your chart center? Utilize MA 50, 100, and 200 for their fund of interest? I don't think you could predict the price movement from the chart center. And we do not encourage you to predict the price movement as well. Okay, the first thing is unit trust price actually is the NAV, means the net asset value. So actually it will be quite a lot different if you compare to stock investment. So normally for unit trust, how we judge or how we quantify funds is based on the fund return. Means we based on performance return instead of the pricing. Means the NAV pricing to determine whether the fund is cheap or is expensive. So basically, how do we identify the particular investment is cheaper in valuation? Normally, we have to look at the underlying asset, means where the fund invests in. For example, the one of the fund example that I think Yvonne used in her presentation slide is the principal Greater China equity. So for example, for this fund, the fund manager is invested in Greater China region. So how do we judge whether the fund is cheap or not, whether we are is suitable or is a good time for us to go in or not? Then we have to look at the underlying asset, means the geographical area that the fund manager invests in, which is Greater China. So we have to identify whether is Greater China cheap right now. So how do we identify whether Greater China is cheap or not? Then we have to look back. We have to check the Greater China index. So you can just go to any Google, you can go to Google's and just type Greater China index. Then actually it will pop up and it will let you know the graph movement of this Greater China market. So you are able to judge the pricing or the variation of the particular market based on maybe a 3-year chart or 5-year chart. Then you are able to know whether in this time, whether this market is cheap or expensive. And then besides actually our research team, we do have this star rating article to also let investors know which market actually is cheap in valuation for now. So the cheaper in valuation funds, actually we will quote higher star, means they will have more star for the cheaper valuation market. Okay, last 2 questions. For the event, if the unit trust is brand new, no historical data, how do we decide to invest in? Okay, good question. So for the event, if the unit trust is brand new, basically for our platform, for FSMOne platform, we do not encourage customer to go into new fund, a totally new fund, because you do not have any track record on the particular funds. You do not know how the fund manager capability to manage the fund for you, because you won't have any track record to refer. So basically, we do not encourage investors to invest into a new fund. And then there's some risk into a new fund as well, because if the new fund isn't making good on the cash inflow, means the new fund is not able to attract more fund inflow, means the fund size, it will be pretty small. And then for those smaller fund size fund, actually the fund manager is very inefficient for the fund manager to invest the fund, or for the fund manager to manage the fund accordingly. So there's a risk that for the smallest fund size fund, the fund manager will decide to close down after some time if they are not able to manage it efficiently. So there's another scenario for those new unit trust fund but we are able to invest in. So for another scenario is if the new unit trust fund, actually they are feeder fund, means they are in the feeder fund structure, they fit under a target fund. So actually what we can do is actually we can go to the target fund to have a look on their past historical performance. So because when the feeder fund fit into a target fund, basically the target fund performance will be the performance for the feeder fund as well. So what we can do is we can just check the target fund performance. Then we were able to know how the fund performed, and also we are able to know their historical performance data. So for the feeder fund, for the feeder new fund, actually this, if the track record of the target fund is good, then actually it's worth for us to invest as well. So it will vary depending whether it's a totally brand new fund or is a brand new feeder fund. Okay, so last question. For a moderate aggressive portfolio, which unit trust you are recommended for me as a new investor? Okay, I think for this question is quite personal. So maybe what you can do is you can email to our client investment specialist, which you can see from the slide over here. You can email to clienthelp.my at fundsupermart.com. So, or you also can call to our various office and reach out to our CIS team. So our CIS team will able to answer your question based on your risk appetite and also based on to help you to build out more personalized kind of investment advice. So I think we do not have any questions for here. Let me check on the YouTube. Okay, so no question from YouTube. I think we will wrap off the section for this webinar. Thank you everyone and good night. And also thanks Yvonne for featuring such a detailed and also comprehensive webinar. So thank you everyone and good night.
Thank you everyone. Good night.